Hello, my name's Donna Hughley. Today we're going to be talking about HOA Financials Accounting 101. As an overview of what we're going to discuss today, we'll first cover the big picture of how all those transactions get into your books and records. We'll talk about how they all come together into what is ultimately the balance sheet and income statement for your association. We'll also talk about some unique aspects of HOA accounting. On a day-to-day basis, your association has various transactions. These can be invoices to your members for dues, collection of those dues revenues, bills from vendors, money collected, journal entries to record things like interest earned on savings account, and checks written to various parties. All of these transactions have to be coded to an account in what is known as your chart of accounts. This is basically just a list of all possible accounts that things can be coded to. If you think of each one of these accounts as a bucket, every transaction gets coded to its respective bucket. That collection of buckets in the accounting world is known as a general ledger. So when you look at a general ledger, you can look at any particular bucket and see all of the ins and the outs of that bucket for that particular time period. After all of the buckets have been filled by these transactions, they ultimately result into financial statements, the balance sheet and the income statement. The first financial statement that we'll talk about is the balance sheet. The balance sheet is a snapshot of your association's financial position at any point in time. A balance sheet today is going to be different than a balance sheet tomorrow because you more than likely will have collected money from a homeowner or have written a check to a vendor. The balance sheet has three major components: the assets, which are the things that the association owns; the liabilities, which are the things that the association owes to other parties; and then the equity or value of the association to the owners. The first item you will generally see on your balance sheet is cash. This represents all the various cash accounts that the association may have. This could be your operating account, money market account, petty cash fund, certificates of deposit, or possibly other investments. If the association is setting aside money for future major repairs and replacements, then those funds are generally segregated into a separate bank account, which is designated as a reserve account. The next item you will generally see on your balance sheet is accounts receivable. These are monies due from other parties. For the most part, these are going to be monies due from homeowners. These are homeowners who have been billed but who have not yet paid their monthly, quarterly, or annual assessments. You may also have a receivable set up from other parties. For example, if you still have a declarant involved in your association, there may be a receivable set up for a required deficit funding. Some associations may also have an allowance for bad debts. This is basically a guesstimate that the board and management will make of potential uncollectible bad debts. It is just a way to recognize these throughout the year rather than when it is definitely known that the debt will not be collected. The allowance for bad debts can be adjusted upward or downward accordingly. Prepaid expenses are just that. These are expenses that are paid before the association actually incurs it. The most common prepaid expense is prepaid insurance. The association will write a check to the insurance company to cover an entire year's premium. The association will then write off pro-ratably or amortize that premium over the 12-month term of the policy. The association may also prepay for supplies such as garage sale signs or directories. They will set this up as an asset and then write them off or amortize them over the estimated useful life of the asset. Fixed asset are things that the association owns. They must be sellable and separable to be set up on the balance sheet of a homeowners association. As a general rule, these will include pool equipment, security equipment, and possibly a computer if there's an on-site office. The association will then write off these assets over the estimated useful life of the asset using depreciation expense. The next section of the balance sheet is the liability section, and under that will be accounts payable. These are monies due to your vendors that have not been paid as of month end. So for example, If you have your June landscape bill and the check does not actually get cut to the landscape company until July, it will be set up as an accounts payable. You may also have accrued expenses. These are temporary placeholders for accounts payable. So again, as an example, you know that you have an electric bill to cover the June electricity. However, you have not actually received an invoice from the electric company. The accounting department will take a best guess of how much that electric bill will be and set up an accrued expense as a temporary placeholder. Then once the actual bill is received from the electric company, it will be moved from the temporary accrued expense up into accounts payable and eventually paid. You may also have prepaid owner assessments. This is where a homeowner pays his or her dues ahead of time. As an example here, you may have quarterly assessments, but a homeowner may send in the entire year's assessments in January so that he or she does not have to worry about writing quarterly checks. Another item you will often see on the balance sheet are unearned assessments. When an association has quarterly or annual assessments, they will send out a bill to the owners. If that revenue is sent to the income statement right then, you have the effect of loading up a particular month for revenue rather than recognizing it pro-ratably over the year. So this is a temporary bucket to hold that revenue until it can be recognized in the appropriate month. So let's say that you are a quarterly assessment homeowners association. A $75 assessment is billed on January 1st. The $75 is temporarily parked in this liability account, and then it is moved over to the income statement, $25 or 1/3 of the $75, January, February, and March. That has the effect of recognizing the income in the appropriate month, and so that it is recognized equally throughout the year. The third component of a balance sheet is members' equity, or what is known as retained earnings if you are used to looking at company financial statements. These represent the life-to-date net income or loss of the association. Each year, that year's net income or loss is zeroed out of the income statement and rolled over into members' equity or retained earnings. Also, you may have retained earnings or members' equity that is allocated between regular operating equity and reserve equity. If your association is setting aside funds for future major repairs and replacements, then that portion of equity is often allocated separately and designated separately on the balance sheet. The next statement that we will talk about is the income statement. The income statement represents the revenue and expenses of the association, and it can be for any period of time, a day, a month, a quarter, a year. You as a board member will receive a monthly financial statement from CMA. The revenue represents the income that the association has earned for that month, and the expenses are what the association has incurred for that same monthly period. Homeowners often ask about cash versus accrual basis of accounting. Cash basis is basically cash in, cash out. Whatever hits the bank account is what gets recorded on the financial statements. Think of that like your personal checking account. The problem with cash basis accounting is it does not give you a true picture of the association's operating results for that period of time. Generally accepted accounting principles require that you use accrual basis of accounting, and that is what CMA provides you. It accounts for receivables and payables. It gives you a better matching of revenue and expenses, and it gives you a much better financial picture of the association. Homeowners associations also have some unique accounting methods that they must comply with. Back in 1991, the American Institute of Certified Public Accountants issued an audit and accounting guideline. This guideline is still in place today and has not changed much since then. Two of the more unique aspects of it is that fixed assets, as a general rule, are not placed on homeowner associations' balance sheets. As we talked about earlier, these assets must be sellable and separable before they are placed on the homeowner association's balance sheet. Another unique aspect of homeowner association accounting has to do with special assessments. If your association has a special assessment, say to replaster the pool and redo the pool cabana, and it does not spend all of the money by the end of the fiscal year, then the unspent funds should be placed on the balance sheet as a liability. Then the next fiscal year, when those funds are actually spent, they are then moved to the income statement. Thank you very much for viewing HOA Financials Accounting 101.